Editor at Bloomberg Opinion, and I'm standing in for your regular Fed Day host, Jonathan Levin, who's off on vacation somewhere special. Joining me today is Alison Schrager, a Bloomberg Opinion columnist and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. We also have with us today Bloomberg Opinion columnist Claudia Sahm. Claudia is the chief economist of New Century Advisors and a former Federal Reserve economist. Now to the meeting. The Fed is widely expected to keep interest rates unchanged at its meeting today in a range of 4.25 to 4.5%. So the thing to watch today won't be the decision. It will be how the Fed and Chair Jerome Powell prepare the market for the next three meetings, which is what we've got left this year. Will Chair Powell encourage the pricing in the market, which currently says there's about a 60% chance that the Fed cuts in September, which is their next meeting? Or will he try and keep his options open? So with that introduction, let me turn to Claudia. Claudia, can you give us a sense of what the messaging from the Fed has been so far going into the meeting, and also what you're watching for in the statement?
Well, the Fed has been in a wait-and-see mode, a let's learn more from the data for the entirety of this year. And hopefully what we'll get today is a readout on some of what they've learned since their last meeting in June. I think they'll be very careful to keep their options open, right? Not make a commitment to any particular meeting, but we could learn a lot in terms of what they're looking for in the data to become comfortable enough that they could get to a rate cut.
And in terms of the statement, what are the things that is there anything in particular that you're thinking might change or will give us a sign of what they're, how they're looking ahead?
There's one piece in terms of just how they describe economic activity. They've been the economy is solid, the labor market's solid. That's a reason we can wait. I think we'll probably see some of the edge come off that. Not dramatic, but I think we've seen some signs of some moderation in the economy. But we'll see if they put that. And then we're also looking at how they assess the risks. There's a piece about uncertainty in the statement. That's something we'll want to see much more fleshed out in the press conference. But there's, just concerns about how tariff policy in particular, although not only, is causing some risks to persistently high inflation that the Fed's not comfortable with. So just to kind of see how they're evolving in that thinking, we'll get some hints in the statement, but it's really going to take the press conference to, kind of give the full picture.
Okay. Alison, just turning to you. Some people are saying that there is not one, but two decisions today that we need to watch for. What the Fed does, and then how President Trump reacts to what the Fed does. And I wonder if you could just walk us through some of the back and forth and some of the pressure that the Fed has been under going into this meeting. How do you think it'll affect the outcome, if at all?
I don't expect it to affect the outcome much. I think Jay Powell is very sensitive to preserving Fed independence. And I think for that reason, the language will be particularly artful about waiting until the data merits an actual rate cut. In some ways, I anticipate the president will then be very forceful that, again, he should have cut. I think his new nickname. And actually, now that I think about it, it's been a while since we've gotten Trump nicknames. I mean, that was always one of the benefits. It's too late, pal. So in some ways, this gives Jay Powell an opportunity to reinforce Fed independence by making it clear that he does not listen to political pressure, and when the data merits it, he'll cut or maybe even increase rates if inflation takes off. And so I anticipate, if in any way, strong language of making it clear that he bows to no one except for the data and what market conditions demand.
And there'll definitely be plenty of questions around that, I'm sure. Mm-hmm. And questions around another expectation today that for the first time, we might see the relative unanimity at the Fed break with a couple of dissents. Claudia, should we read too much into that? If we do, in fact, have two Fed governors dissent from whatever the decision might be?
We knew coming into this meeting that there were differences of opinion on the FOMC, and that's healthy. To see an official dissent, it is noteworthy, but it doesn't really change the policy outlook, right? They got to get to a majority to actually cut rates. And so it's something of interest. But again, we knew this going into the meeting that they were divided.
All right, here we go. We are at 2:00 and we have the headlines crossing. Just pull this up. Fed releases the FOMC. Labor market conditions remain solid. Inflation remains somewhat elevated. Uncertainty about economic activity outlook remains elevated. So those are some of the headlines crossing as the Fed, as expected, holds the benchmark rate in a 4.25 to 4.5% target range. So that's completely as the market had predicted. This is the fifth straight meeting that the Fed will be holding rates unchanged. And now let's see if we can get a comparison of the statements. So what has changed? It's taking a little bit of time to download what has changed. So what has changed is this. At its last meeting in June, the Fed had said that economic activity has continued to expand at a solid pace. That has now changed to moderated in the first half of the year. So the FOMC there, taking note of the softening that we're beginning to see in some of the activity data. If you go down to para 2, where the Fed had initially said in June, uncertainty about the economic outlook has diminished but remains elevated, they have deleted the words has diminished. So it now reads, uncertainty about the economic outlook remains elevated. There's a little change regarding net exports, but I think that was sort of expected. So let me just scroll down to the part where we learn who voted against the decision today. Voting against this action were Michelle Baumann, who preferred to lower the target range for the federal funds rate by a 0.25 percentage point at this meeting. Absent and not voting was Adriana Gugler. And then we have, rather unexpectedly, everyone else on board. So,
well, no, Waller voted against also.
Did he? Sorry. There we go.
Bowman and Waller.
Yeah. You're right. Bowman and Waller both voted against. So that is, again, as expected. So just coming back up to the top of the statement, the comments on economic activity and on uncertainty. What do you all make of those changes? Why don't we start with you, Claudia, since you were the one to sort of point to those pieces?
Yeah, so we did see the economic activity has moderated in the first half. I think that's the GDP data, and we got the second quarter today. There were really big swings in the first half, so it's kind of hard to read through. But for the quarter as a whole, in particular, look at key demand components like consumer spending, private fixed investment. They showed some slowing, not dropping off a cliff, but slowing from the second half of last year. And so and that is an important piece, kind of a baseline piece for then thinking about forecasting something like the labor market. Though the statement maintains that the labor market, they view where we're at right now, it's in a good place, it's solid. So that part didn't change, but I think a recognition that we do see some activity slowing, as I think was expected. The other piece that is interesting to me is their treatment of uncertainty. It's easier just to say uncertainty is elevated, right? Mm-hmm. But if we think about the fact that, a key stumbling block for the committee to lower interest rates is they see risks that the inflation is going to remain persistently above target. That's largely the risk, the concerns about the tariffs, but I mean, just broadly speaking. And one could look at, say, some of the recent trade negotiations, the pattern to really threaten big numbers, but then back off as kind of helping settle some of the uncertainty. But we're not getting any hint of this, right? Like they're just kind of saying it's still very uncertain, which to me says you probably have a committee that's still quite divided in thinking about those risks. Because for it to show up in the statement, the committee has to be comfortable with the changes being made. Like this is kind of a majority document. It's not one Fed officials. So, we're making some progress on the data, but I suspect this is going to be, we won't maybe hear a lot of signaling on September.
So you think that this is, going into the meeting, the odds for September were about 60%. Do you feel like what we've seen so far, which isn't a great deal, does that
a few edits? It for a lot of reasons, I came into this thinking that the Fed would probably move its first cut in October. Of course, that we could have big changes in the labor market that might pull that sooner, but just they were on a path that probably would take them a little bit longer. The Fed they're in risk management mode. They're trying to assess the risk, get comfortable, hope, see data that pulls some of the uncertainty out. And that just takes time, right? And so that's the Fed's process, which does make them slower. I mean, the president's all right. They move slowly, but it's with deliberation, right? And so, yeah, it's not, and we'll see in the press conference, but there would need to be some laying of groundwork, I think, to get to a September cut, and the committee may just not be ready for that. I mean, that may be the message.
Right. I mean, the markets don't think that's the message. If you think that sooner cuts are better for stocks, both the S&P and the Nasdaq 100 hit sessions highs. Alison, let me turn to you. Do you think that a September rate cut is still on the table? And more importantly, do you think we need to have lower rates sooner rather than later?
I'm not sure if it was ever really on the table. I feel like markets keep overestimating the odds of a cut. I think it's just like a lot of wishful thinking or manifesting on the part of markets. But I mean, if you look at the data, it's, you see some signs of weakening here and there, but I think it's hard to justify a rate cut. I mean, look at the stock market. Look at, all this uncertainty that we're facing is largely inflationary. And yeah, I mean, there's some signs of softening the labor market or with consumer demand, but to the extent that we always said we needed to see the whites of inflation's eyes before we did anything, we also aren't seeing the whites of eyes of like a serious slowdown in the economy either. In fact, still pockets of serious hotness. I think this, the justification for a rate cut isn't necessarily the economy slowing. It's that we're still in this contractionary posture to bring down inflation. And I think it's hard to, Claudia might disagree. She's been in the Fed. I think it's hard to argue that the high rates are having a contractionary impact on the economy at this rate. I mean, we might just be in an equilibrium higher rate. Maybe the economy is not as sensitive to the Fed funds rate right now as it used to be. So if that's the case, I think it's just hard to argue. And I think the statement sort of reflects that. I think if we do see a big change, if we do see a big change in inflation, I think if we do get a really bad jobs report, I would expect, that to change maybe. But where things are, I think it's hard to justify a rate cut. And honestly, and it's a very sensitive time to do that. Instead, I think in terms of Fed independence and showing that, nickname or not, Jay Powell is going to hold parson, maybe embrace being too late, Jay Powell.
Well, I guess we'll see. It's probably worth pointing out that, now that we're on, the next meeting is in September. The Fed now has the opportunity to look at two more sets of inflation data, two more sets of jobs data. So certainly going into the September meeting, they will be better informed about the economy than they are today. And so, there is that. But Claudia, to Alison's question, do you think we are seeing the kinds of softening that requires a rapid sort of easing in policy? We had GDP numbers today. The headline numbers were strong, but some of the details, some of the underlying numbers on consumption were weaker. If you combine first quarter and second quarter GDP data, it again paints a picture of an economy that is not at potential. How do you sort of square that with where monetary policy should be?
Right. Well, so to answer your question, I don't think if we look at economic activity or the labor market that it says you should be cutting right now. And even with some, I think there are some risks in the labor market that could play out, and you shouldn't be cavalier about that. But the case, if one were going to make the case for the cut, and as Alison said, they're in the federal funds rate at 4.3%. That is putting some restriction on the economy. It's modest. They describe it. I think if you look in some of our interest rate sensitive sectors like residential investment, the housing market, there are some signs there, right? But it's not a dramatic weight that the Fed's putting on the economy. I think the path to a rate cut is one to have the Fed get comfortable with the idea that these tariffs are going to be a one-off. Right? They're going to boost inflation. We're already seeing that in the data. But the idea that it doesn't get into this where it starts having feedback effects and loops, and these are be real concerned if you start having tariff levels that really shut down trade and shut down supply chains. Well, then that's where that risk gets a lot higher. So maybe now we're out of that risk, and so it's lowering it. But if the Fed gets comfortable with the idea of, well, they're one-off, they're going to come, whatever inflation it causes is going to unwind without us doing anything. We don't need to do anything with interest rates. Well, then you look back at the rest of inflation, and we've had some encouraging signs in recent months with both the housing inflation, the non-housing services inflation that has been really slow to normalize after the earlier surge. We get a few more months of that if you're comfortable looking through the tariffs. Then the reason for the elevated Fed funds rate, I'm not talking about dramatically elevated, but the being higher, well, then that steps to the side if we are getting inflation back to 2%. But again, there are a lot of pieces to that argument, right? You've got to be able to willing look through the tariffs. You've got a few more months of the core services inflation would help a lot. But that's an argument that needs to be developed. And like, here's the data we're looking for. And another, I think, comfortable argument for a lot of the FOMC is we just need more data. We don't want, like, we're not ready to take that step of looking through. We're not willing to accept, 3 months of good data, but it could reverse, and it has in the past. So I think, but in terms of an urgency to cut, it's not there. But when the Fed is doing things because it's urgent, we are not in a good world, right? So we should try to stay away from that and kind of be forward-looking.
It's quite a fine balancing act, isn't it? You don't want to be too early because you need to see what's going to happen with tariffs and inflation, but you don't want to be too late. And I think that's the point Chris Waller has made, right? That you don't want to be at the point where the ice is cracked and you've gone through, and you have a labor market that's really beginning to struggle. Also, I'm curious what your sense of the labor market is. There are different people who look at the same data and will paint it differently. We have a very low unemployment rate that stayed that way for a long time now. How do you think about the labor market right now?
Well, I mean, overall, I'd say it's good, but there's certainly some worrying signs. One, in the last employment report, so much of the growth was in the government, not in the private sector. I'm getting more and more concerned about the unemployment rate for new college grads. That's a very worrying trend. I mean, they're pretty almost at recession level unemployment levels. And, it's very damaging to graduate in a bad labor market. It can follow your wages for years. So I think these are very serious concerns. And but I think it's a valid question if monetary policy can deal with that. If, a quarter or even a half a point rate cut will do anything for college grads. We don't know what's going on, I think, very well with the market for new college grads. I mean, there's speculation it could be AI. Companies need fewer young workers now, although the data doesn't seem to bear that out. I don't know if we really know. We don't know if this is cyclical. We don't know if this is structural. And if it's structural, there's not a lot the Fed can do about it. So it's hard to justify that we need to cut rates to juice the stock market to get people to hire young workers. It doesn't work like that. So there's definitely a lot of things the Fed has to keep their eye on. But I mean, I think from the data right now, we're really grasping at higher order derivatives to say the labor market is in trouble and requires a rate cut. I think the question that, reasonable people can disagree on is how much of an art is monetary policy or a science? And can fairly small rate cuts in advance of weakening really have an impact? And are they necessary? And what are the costs? Particularly, as I said, there are hot pots of the economy that a rate cut could exacerbate. Like the stock market is not doing too badly. It's pretty hot.
Not badly at all.
Yeah. And well, I think we're seeing the impact of high rates on the housing market. Although to some degree, that's the Fed's fault for engaging in QE for a really long time and very aggressively. We're seeing, I mean, the longer term rates and the short term rates have always been a somewhat segmented market, maybe less so in the 2010s, but it seems like they're back to being segmented now. So I saw the broker I bought my apartment from, tweeting, real estate brokers are waiting with bated breath for this rate cut. And I'm just like, it's not going to matter to you. It's not going to impact mortgages, no matter what happens. Like, I just wanted to tell him that, don't get too invested. So, I think definitely there are things we should be worried about in the economy, but I think we have to go back and step back and also realize what the Fed can even do realistically.
Right. And to your point, the last time that the Fed cut, we did not, in fact, see borrowing costs, mortgages in particular, come down. They actually went up.
Yeah.
And, part of that was potentially the market saying, look, I think that there are still some inflationary pressures around, or the economy still looks quite healthy, and maybe this was premature. Would you agree? Claudia, Allison, either of you?
Yeah, I mean, I think thinking about the rate path last year around the cut, I mean, one has to remember that you had this kind of building worry about a potential recession. Things were really weakening. And so you did see ahead of the Fed cutting, rates come down over a period. So there could also be the Fed's stepping in, we're going to avoid the recession and rates go up. It is so hard. I mean, you all know this. It is so hard to tell the story out of the path of interest rates or anything in the markets. Now, to your point, though, I mean, one shouldn't bank on, the Fed cuts by 25 basis points and it actually has a meaningful, predictable effect on any borrower kind of consumer business type thing. So yeah, it's important to make that distinction.
I just want to spend a few minutes on the dissents we got today. I'm curious, how our audience should be thinking about this. Should they be thinking about this as the Fed that is now sort of, Fed FOMC members that are now sort of arguing and bickering? Or is this about sort of building a case for the Fed to start to change direction? Which way do you think? How should we read this?
I'd be careful to read too much into it. Both Waller and Bowman have dissented in the past, not at the same time, frankly, in more hawkish directions than today. But data change, people's opinions change. The FOMC, and it's clear from a lot of the other documents that they give us, say the minutes or just listening to Fed officials in public, they disagree. Right? They read the data differently. They have different views on what's appropriate policy. We have a lot of information that tells us it's more rare to see it in terms of a formal dissent in the vote, but it doesn't change the dynamic. Dissent is healthy. I don't think there's a problem. And it is interesting. Chris Waller gave a speech a few weeks ago where he very openly transmit this was going to be his decision and here's his case. So there was also kind of a deference to not blindsiding anybody in the meeting. So I think this is fine. Other central banks do a lot more dissents. I think it's probably a healthy thing, particularly if it comes backed up like it did with Waller, with really clear, here's what I'm thinking and how it's different.
Allison, do you see that the same way, or?
Yeah, I mean, I think the dirty secret monetary policy that a lot of people don't understand is, this isn't a fine science. And, there's a lot of good interpretations. I was just saying, how important is it to preempt weakness in cut rates? I mean, we don't know. There's a lot we don't understand. And I think what part of the philosophy of being more transparent was not poking a hole in this belief that this Fed's this all-knowing body that can completely fine-tune the economy. So it is healthy to have dissents. I think the one thing that may be a little more interesting about these dissents compared to normal is that, there are rumors that Waller is gunning for Fed chair. And I think there is some concern, maybe not concern, but I'm making an observation. I'm not necessarily concerned about it. But, to some degree, he is maybe playing a little bit of shadow Fed chair here. But as Claudia says in a very nice and collegial way, right. Gave everyone a heads up that he might be in this role. So I think that makes it a little bit more interesting, just the political dimension here. But as a concept, I think dissents are healthy too.
I mean, it certainly seems to point to this idea that even though, this is the Fed exercising its independence, we are beginning to see some implications or some impact from President Trump's criticisms. Clearly, people, on the FOMC who have ambitions know what direction they need to be thinking in. Am I being too ungenerous here?
I mean, no, even after Waller made that speech, I mean, that was the speculation, was that he was positioning himself to be, I think we should recall that, the administration said, we kind of like the idea of a shadow Fed chair who's second guessing Jay Powell in his final months. So, I mean, maybe that comes from in-house. and is formally on the record, rather than as someone just at a think tank or another part of the government doing this. So I think it's a little more interesting than normal, maybe for that reason. But again, we don't know. I mean, we can't look inside his head and know his ambitions, or maybe he genuinely believes for good reason, and there is a good case to be made. I don't personally agree with it, but I can see how a reasonable person would make the case to cut rates now.
Right. And, he laid that out, I think, quite clearly, as Claudia mentioned, in the speech he gave earlier this month. I want to look ahead to another speech that, certainly Fed watchers look forward to with anticipation, and that's the Jackson Hole Symposium, later in August, where we should expect a rather large sort of speech from the Fed chair. How do you think Powell uses the forum this year? Is it going to be about rates, do you think, in preparing the market, or is it going to be more about Fed independence and what needs to happen on that front going forward?
It's probably not going to be on either of those two. I mean, the main, it has been, and I'm sure it'll get mentioned again today, that at least a portion of their strategic framework review will be finished this summer. And when the first strategic review is done, he used his Jackson Hole speech to lay out the new frame. I mean, this was in the midst of COVID, and I mean, like, no one's paying, like, the Fed's new ideas about monetary policy, but this would be the time, and I think an appropriate platform for him to discuss the changes in the framework. What is likely to feel very jarring is the discussions about this is all very backward looking. This is, how did that new framework work during COVID or not during work? And I suspect basically the framework we're going to get this August is going to look really similar to the framework before the first review. It's going to be just unwinding a lot of changes and things like that, but it's all very backward looking. As a review should be, right? Like, so I think it probably could disappoint in terms of like where the Fed is headed, that conversation. I don't know. Allison, do you disagree?
Yeah.
What's he going to do?
I mean, just, I always think of Jackson Hole as sort of setting the intellectual framework that the Fed is going with. Like, there's always these big, important economic papers that sort of help us rethink monetary policy. And I've been reflecting a lot lately, for personal reasons, I guess, on, the intellectual legacy of Fed chairs, and really thinking what a big deal Bernanke was. I mean, he really turned out, I think, in a lot of ways to be one of the more consequential Fed chairs in terms of really bringing a lot of academic literature on the way monetary policy should be conducted into the Fed. And certainly, I mean, the way he revamped the tools alone was, quite significant. So, this is his last Jackson Hole. So I would anticipate, what Claudia says is rethinking the last framework review, which kind of is where the sort of literature and thinking and philosophy of monetary policy does sneak in. So, I mean, I guess just most trivially, well, not trivially, but like, we're going to see rethinking of flexible average inflation targeting, which sort of justified maybe letting the economy run hot for longer just to get inflation up. And, we'll probably expect some rebuke of that. Although even that, they might say, well, we'll maybe bring it back when we get back to the 2010s when inflation was like barely anything and rates were really low. I don't know if we're ever going back there, but maybe they're maintaining that option. But it depends, I guess, on how Jay Powell wants to be remembered as Fed chair. And does he want to be that guy who made the big intellectual splash like Bernanke did, or sort of just, go out with maybe flexible average inflation targeting wasn't a good idea?
Okay, maybe on to then comments from Jay Powell that are closer at hand. Claudia, what would you like to hear from Powell in the press conference that is about to start in, just a few minutes?
I want to know what they've learned since June, right? We have gotten a lot of data since their last meeting. The data don't speak for themselves. I want to know how the committee, and Powell, when he speaks, he's speaking for the committee. It's like, what do they get out of this? Or are they just as confused about what's coming next as they were in June? He won't say quite those words, but I mean, like, I just want, like, what are you thinking? What are you learning here?
And that's an important distinction, right? When Chair Powell speaks at these press conferences, he's not speaking on behalf of himself, but the entire FOMC. And the decision making also is a group effort, not a singular sort of dictatorship by one man. Alison, what is it that you would like to hear from him?
Just a little bit more salaciously, I would like to just sort of have little like bits of pushback to maintain Fed independence. I just personally enjoy that. But.
I mean, certainly the question will be asked, so you'll have plenty of opportunity. And he has in the past, I think, used the presser rather curtly to, just stand up for independence. Is this going to, do his words carry as much weight today as they did a few months ago? We know he's going out. We know that he's not going to be reelected to this position. Does that weaken his forward guidance in any way?
I don't think so. I mean, we still have, the market is still expecting several rate cuts, or not several, a few rate cuts before he goes out. So I think they're still looking for that and, trying to price that in.
Right. And Powell will be absolutely instrumental in the timing of that first cut, because that's getting the consensus there that it's time to cut. So yeah, I think because if this Fed is not one that's signaling about the end of 2026, 2027. I mean, we don't hardly know what's coming right around the corner. So I think he will remain quite consequential as Fed chair.
And if you had to bet, Claudia, when does the first rate cut come?
October.
Alison?
Maybe January. Like,
January. Ooh, that'll disappoint some people.
I don't think we're going to get the data before then, but and I don't believe Powell is really reacting that much to Trump, but it certainly, if he is ambivalent, would go later rather than sooner to show that he's not being bullied.
Well, with that, I will leave all of you out there to listen in to the press conference, which will be as interesting as ever, even though the decision today was to keep rates unchanged, on hold at 4.25 to 4.5%. Thank you, everyone, for joining us today. Thank you, Claudia. Thank you, Alison.
Thank you.